Hello, Dr. Gamble here with the second part of Chapter 1's presentation from Foundations of Financial Management. So where we left off, we were going through some of the definitions and we were on the forms of business. So we were looking at this particular chart, and what I want to do is actually bring up a little clearer chart for you to look at. So when we look at this particular spreadsheet, it's actually a comparison of sole proprietorship, general partnership, limited liability corporation, S Corp, and C Corp. And you can see the various attributes that each one has. And if you just take note, a sole proprietorship has the fewest, followed by the partnership. The one with the most of the attributes is the limited liability corporation, then the C Corp, which is a taxable entity. And just FYI, if you're thinking about starting a nonprofit organization as labeled by the IRS as a 501c3 charitable organization, it would be a C Corp, however, but not taxable. And then the last one is an S Corp. And the S Corp acts a lot like a C Corp, however, it allows for the pass-through of gains and loss to personal income tax. So the other things we were looking at, as I mentioned in part 1's presentation, is agency theory, right? And the reason I don't go through all these definitions because I am running with the assumption that you have read the chapter and are comfortable with the vast majority of the definitions. But this concept of agency theory ties to the maximization of wealth for stockholders, right? And the agents that work within corporations are typically referred to as the financial managers. They work for the corporation, and the corporation is owned by stockholders. Therefore, the maximization of wealth for stockholders is managed by the financial managers, who are the agents for the stockholders. So hence the concept of agency theory. Institutional investors are basically large firms or very, very wealthy, high net worth individuals who invest into businesses and ideas at very large sums, typically $100 million or more. Now, insider trading. Now, this one has been in the news a lot lately. And if we just look at some of the things, there's a New York Times article, just giving a quick summary of some of the things that have been happening as pertains to insider trading on Wall Street. Remember, we spoke about Wall Street as being the financial market, right? And Wall Street is considered the hub of the world for finance. Well, the U.S. federal prosecutors has convicted an insider trader, a billionaire, for 10 years using information that was not publicly accessible. Has a sentenced to 11 years and fined $10 million. Right? A billionaire lost or has no access to his wealth just because he wanted to make more money, and fined 10 million. So find 10 million off of $1 billion and to give up 11 years of your life. I don't know. Doesn't sound like a good deal to me. There was another person convicted in relation to this insider trading scandal, and Rajit Gupta also was convicted for insider trading per the Rajaratnam scandal. Now, I typically do not use insider trading. However, there's some good cited information within this particular wiki link, and it just lists out a number of cases that has hit on federal courts, right? Dating all the way back, to this one's 1966, and the Rajaratnam conviction, to bring it fast forward 2012. So insider trading has been an issue in financial markets for some time, but now prosecutors seem to have found a method by which to make insider trading allegations stick to get convictions. And just an interesting piece of fact, members of Congress are exempt from insider trading laws. Now, I don't know, you have to form your own opinion on this. If financial insiders are not allowed to trade with inside information, it's a bit perplexing to know that members of Congress can trade on information that may not be readily available to the public. Financial markets. So we introduced this concept of financial markets as Wall Street being the hub, right? So now let's drill down into financial markets. Right? Financial markets actually fall into a number of categories, right? When people think about what goes on in financial markets, they think about what is referred to as the big board, with ticker symbols and prices going across, and then traders on the floor sending signals and saying, I'll buy and I'll sell, right? There always has to be a buyer and there always has to be a seller for a financial market to work. So when you look at financial markets, there are public financial markets, corporate financial markets, and then money markets, capital markets, primary markets, and secondary markets. A public market is basically what Wall Street is, where people buy and sell stock. In the early days, it was just an outcry system. They literally met back in the 1700s on Wall Street. Group of people saying, I have this for sale at this price, and someone would answer back, I'll buy it. I have this to sell at this price, I'll buy it. I'll sell this at this price, I'll buy it. So now we've moved to a more computer intensive, data intensive environment. The New York Stock Exchange still has what they call specialists and other people of that nature, human intervention, whereas the NASDAQ is all computerized. Now, a money market is an investment market for basically short-term money, 12 months or less, right? And capital markets are basically financial markets for investments of 2 years or more. Now, primary market is when a new security is brought to the market, it gets sold on the primary market. So to play in the primary market, you typically have to be an institutional investor, or what is referred to as a qualified investor, right? A qualified investor would be an individual that met certain net worth and income characteristics. Once securities are sold in the primary market, that means money is being given to a company for their security so the company can go build out its wealth for its stockholders. Now, these people who bought these primary securities, they may hold on to them or they might sell them. If they sell them and the company's not buying it back, they might sell it on the secondary market. The secondary market is just where investors meet other investors to buy and sell the securities that they own. So the big board that most people are familiar with That is the secondary market where investors somebody would be buying this ticker of LOW for $2.38, and there's somebody else who will be selling that LOW for $2.38. Now, the last concept that was introduced in this chapter was restructuring. Now, restructuring refers back to the capital structure. Remember, capital structure consisted of two primary parts, equity and debt. Now, when you restructure within a company, remember, you have equity and debt. So we may want to restructure the company a little bit differently. So right now, this company has a credit debt of 12%, a loan of 22%. Right? So what's the difference between a credit and a loan? A loan is a debt, but you receive money to go do something else with it, i.e. buy a property. And credit is money that you haven't received but have the ability to use. Right? And then once you've used it, you have to pay it back. And then on the equity side of this pie chart, you have preferred stock at 18%, common stock at 46%, and then warrants at 2%. So if you wanted to restructure, you would restructure to change out these percentages. Now, this concludes the presentation for Chapter 1 for Foundations of Financial Management. This is Dr. Gamble. Have a great day.